Let's look at the rules in detail. Number 1. A Division 7A complying loan agreement must be made in writing between the lending company and the borrower. The maximum term is 7 years and the minimum interest rate is the benchmark interest rate set by the ATO each year. Number 2. Minimum yearly repayments, which is the principal and interest payments, must be paid to the company by the end of each income year. They cannot be rolled into a new loan, nor can interest be capitalized into the loan. The minimum repayments can be paid via set-off against something that the company owes to the borrower. Most companies declare dividends to their shareholders so that the shareholders can meet their minimum repayments each year. Instead of paying out the dividend in cash, the dividend payable is set off against the minimum repayment owed to the company. Say Roger decides to enter into the complying loan agreement and Dodger Co. declares a dividend to him for him to meet his minimum repayments. Dodger Co.'s balance sheet would look like this. At the end of the first year of the complying loan, there's a loan receivable from Roger of $700,000 and interest receivable for the year of $32,000. Dodger Co. declares a dividend of $118,000 to Roger, and this remains outstanding as a dividend payable. The minimum repayment of $118,000, which is made up of principal of $87,000 and interest of $32,000, is set off against the dividend payable so that no cash needs to be transferred. This is all merely paperwork, which is what accountants are paid to do. Number 3, the loan cannot be forgiven by the company, otherwise the forgiven amount is a deemed dividend under Division 7A. Number 4, the company pays tax on the interest income, but the interest paid may not be deductible in the hands of the borrower, where the cash or the loan is used for private purposes. This is the tax cost or the tax leakage from entering into a Div 7A complying loan agreement for funding private lifestyles. If the cash was used to produce income, like buying an investment property, then the interest would be deductible in the hands of the borrower and there would be no tax leakage. Overall, the ultimate benefit of entering into a Div 7A complying loan agreement is that it allows cash to be taken out of the company now while spreading out the top-up tax over the next 7 years.